Hi, everybody. Welcome back to Foreign Currencies with Scott. So today is Sunday, and we've just completed our second week of our $1,000 challenge for the year. Now, if you'll recall, the first week we made money, so we were up for the year. What happened in the second week? Well, in the second week, we took a little different path. Rather than three or four or even two trades entered, we were only able to enter one trade for the week. Now, was that trade a winner or a loser? Well, technically speaking, it was a winner because we ended up with more money when we exited the trade than we did when we started. However, we did not meet our take profit price. So we call it a win, but not exactly a win in the way we want. We actually had to take a manual exit. So we've only spoken about manual exits just a little bit on this channel, so we need to spend a little bit more time talking about it right now. So when we make a trade and we are hoping to go up or to go down, we're hoping to go in a direction where we go 30 pips and make $72. But if we go in the wrong direction, we go 20 pips and we lose $48. So what happened on Thursday of this past week was we were on our way to a winning trade, but the day kept going on, and the day just didn't want to end. So it didn't want it to give us our take profit. It went up and just kind of hovered there and didn't quite want to exit for us. Now, we've talked before about holding overnight, and in general, we try to avoid holding overnight. So within 20 to 30 minutes of the market close, we saw that we were getting close to our take profit. We saw that the price value was about to go down again, and we just decided to manually exit. So we actually made a little bit more than $48 plus some cents. And that's a good number to have made because that means it will cancel out our next loss. So, our losses are $48 and our wins are $72. So the fact that we will have canceled out that next loss will help us going into week three. Now, what I want to do is I want to talk a little bit about why we want to get out. Now, as it turned out, this trade would have been a winning trade and would have made us $72 if we had just left it alone and not manually exited. But it did it the hard way. Now, what do I mean by the hard way? Okay, I've talked many times before about the importance of the spread. That's the difference between the sell price and the buy price. And the main reason that we trade during New York or London markets and not the Sydney or Tokyo markets is because the spread is much smaller. So typically for us, the spread is only 1 to 2 pips. So I want to show you what that means. So when the spread is just 1 to 2 pips, let's say our take profit is here and we want to go up to hit that take profit. So when this is the spread, what that means is when we meet the take profit price, it won't close us out yet. It has to cover that spread. So it has to go up that little bit more before it closes out. But that's okay. We're used to that. And with 1 or 2 pips, it usually hits it pretty easily. It's not too often that we get into the take profit and then go away and then lose. So it's just a little bit more we have to go to make that trade exit happen automatically. Now, what happened, and I even have video for it that you'll see later, is that when the Sydney market opened and New York closed on Thursday, the spread went all the way up to 12. And I think at the time we were recording the video, the market was still live and we were over 10 pips. So I want you to see what that means. So now the spread is 10 pips. while we were in the trade, it moved up to 10 pips. So now what that means is if our take profit is here and the value of the pair goes up, it meets it, but now it hasn't covered the spread. So now instead of just 1 or 2 pips, we need to wait all the way until it went that 10 additional pips to cover that spread before it would automatically close. So I think that that did actually happen Thursday later in the evening, but that is not an easy way to cover. So, if the take profit, excuse me, if the spread had been only 1 at that time, it would have exited a lot sooner and it would have been a certain exit. Here we needed to wait for 10 more pips, and that's just not as likely to happen. So we try to avoid that situation, and that is what we did. So before New York closed, we picked a spot, we got out, and we took a little more than $48, which will cover any next loss we have. So we're in good shape. We've made money both weeks number 1 and week number 2. So we're getting excited now on Sunday evening to get set for week 3. So we'll see how many trades we have potential for in week 3. But going in, we're looking quite good in our fund, and we're well on our way to meeting our $1,000 challenge. Okay, so there's just a couple of extra videos, and they're both from Thursday. They're both, I believe, while the market is open, and you can see us talking about this a little bit more and then closing the trade manually. There's no video for Friday because Friday there was no trade. The price was not more than 30 pips away from the target price, so no trade was entered. Okay, all right. So if you have any questions, do let me know in the comments below, and I will certainly see them and look at them. So until next time, check out the videos and let me know how you're doing as well. I'd love to hear from you. Okay, thank you. Bye-bye. All right, welcome. We're going to take a look at the Thursday market, and we're just going to scroll back here so that you can see the Wednesday close of New York on that vertical line. And we're currently in a trade, so sometimes you can see some things that are a little bit more interesting while you're still in the trade. So I thought I would make a quick video to show that. Now, let's take a look first of all at the New York close. We're at the middle horizontal line and we moved down to the 30 pips away low mark. So as we cross over into Thursday, we've breached the line, and at 3 a.m. Eastern time when London opens, and I'm just going to expand this so that we can see the 3 a.m. time there, we were actually both below the low line and having green candles. So that is an indicator to enter a position, a buy in this case, to get back up towards the New York close. So if we had bought at 305, which the fund that we're working on did not, but you may have because it met all the criteria. So let me just draw in another line here at the moment just so that I can show you something. Okay, so at 3 a.m. we had a green candle, we were below the line. So the 3:05 a.m. when 3:05 started, that's where we were right there, $1.33 and 86.1 pips. So what I have done is, if you follow this horizontal line that I've just drawn over to the right, you'll see that there is a structure, a vertical rectangle that's shaded in. So this structure here. So what that represents is if one had entered a buy at 3 a.m., it's 3:05 a.m., that's the 30 pips one would have needed to close out with the take profit of $72. So what we can see here, and I'm just going to delete that now, but what we can see here is that the red candle at 5 a.m. has a bit of a wick, but it did not get to the top of that shaded rectangle. So it did not close out then. And in fact, it turned around and went back down such that it went back to the entry price almost, and then for sure penetrated it at 8:30. You can see here this red candle with the big long wick below went below the shaded rectangle where one would have entered at 3:05. But then didn't close out. It wouldn't have closed out because it didn't go 20 pips below it. And if we had stuck in there with that, you could see that before noon, this long little run of green candles would have gone past that take profit and taken us out. So it would have been a profitable trade. Now that is not what your host did. Your host does what he sometimes do. Easy for you to say. Your host did what he does sometimes, which is he did not get up at 3 a.m. and he waited until 8 a.m. to see what was happening. So 8 a.m. is the reopening of the New York market. And what we can see here at 8 a.m. is that we were still below, or at least once again below, the 30 pip down mark. And we were able to buy right there. So you can see the red candle at 8 and then at 8:05 a green candle. So we were able to buy at that low. So let me just point that out to you in case it's not clear. So right there, the bottom of the green candle or the entry of the period, we were able to buy right there. Okay. So that trade is still in. What has happened with that trade? So that trade, and since we're still in, I can press my finger on, on the trade itself, and it will pull up all the relevant information. So you can see the stop loss line, the take profit line over on the far left, $72 positive, $48 negative. You can see that we have not really gotten to that stop loss line at all, not close to it. We had one candle after 8 a.m. that got kind of low, but then we moved higher and higher, and around noon we almost got to the take profit. And you can see that it's just so close there at noon to the take profit line. That can be very tempting to exit, but remember, we don't want to dilute that $72. If you think about it from the opposite view, what if it were close to losing $48? In our minds, if we were down $44, would we think, I'm just going to manually close this and get out with a loss of $44 rather than having it happen automatically? No, we would never think that way. We would say, oh, it's close to stopping me out, but it's not going to do it. It's going to turn around and go the other direction. We would wait. Okay, so we need to apply that same logic when it's getting close to the $72 win. It's almost there, but it's not quite there. We need to wait. That can be very difficult sometimes. If we'd closed out manually there, we would have gotten maybe $68, $70, which is almost 72. Nothing wrong with that. However, it is diluting our winnings, and it's diluting our 50% goal for the year, because we know that when we lose, we are definitely going to lose $48. We're not going to manually come out at 43 or 44. So it's important, if we can, to try to let it ride up to that 72. There are exceptions to that, and we may hit one of those exceptions later this afternoon, but we'll see. So not only did it not cross the take profit line around noon, it then went pretty far down, as you can see, and by 1 o'clock it had almost gotten all the way back down to our entry point. But now it's slowly climbing back up, and here we are at about 2:30, and it's back up. And if you look at the left, you can see that it's at $46 right now. So we're going to hang on. We do not like to keep a trade open overnight if we can avoid it. So the market will close here in about 2.5 hours. So we're probably going to make some sort of decision before that time as to what to do. And you will see that in a later video. All right. See you again soon. All right, so we're just going to take a look at the end of the day, Thursday, and we said we might have to take some manual action, and as it turned out, we did. So we're closed in this trade now, and so some of the lines on the chart will have disappeared because of that. But I just want to go back here and take a look and see what happened. So you can see here at noon, we got very close to our take profit, did not hit it, and then went back down. And then as the day went on, we got closer to that 1700 time, which is when New York closes. And so we got fairly high again, but not as high as at noon. And then we got a couple of red candles here. I've drawn the vertical line where we got out. And we got out at just over $48. So this was not a case of I'm almost at my 72 and I just want to get out a little early, which we advised against. This was a case of the day is almost over. New York is about to close, and I need to close this trade. I don't want to stay in it overnight. And so the reason for getting out after those two red candles at $48 is because, as you know, $48 is what we lose if we hit a stop loss. So we just wanted to cover that. And so we did. As you can see, after the vertical line where we got out, it went up a little bit again, but it still did not hit our take profit. And so if we had left this, we would still be in. But there's something else I want you to see, which is to look up in the upper right-hand corner and notice the difference between the sell and buy prices. So they're both at 134, but one is 13.8 and the other is 24.1. So that is over 10 pips. So this is what I talk about when I say that the spread during the non-New York, non-London markets is considerably higher. So a 10 pip spread means that when we normally have a 20 pip stop loss, we would get within 10 pips of that now and be stopped out because of the difference between the sell and the buy prices. So normally this is between 1 and 2 in the New York or London markets. During the foreign markets now, it is over 10 and would not be good. Now, if you don't get close to your stop loss, it will also make it harder to get to your take profit because of that spread. But if you end up not closing out overnight and survive until the next day when the spread is again is between 1 and 2 pips, you will be okay, but you do have that added risk of the large spread in the other markets. So we chose to get out at just over plus $48. We'll take a look at that when the Sunday video comes out. This is just the excerpt to see what happened. So we did get out. We got out a little above $48. So that will cover any future loss, but it's not really considered a win.